we just went through our first recession where tech didn't recess, right? But because of its size and its headliners, it kind of overwhelmed the data in the rest of the economy enough to make it look like it was just a slowdown.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. I'm Jim Warden, Chief Investment Officer for the Wealth Consulting Group, joined by my co-host Tally Leger, our Chief Market Strategist, and Paisley Nardini, who's on our investment committee. Thank you guys for joining me, and we're super happy to welcome back Jim Paulsen. Welcome, Jim.
Thanks for having me back, guys. That's always a good sign, at least this time.
So, Jim, I think last time we spoke, we were all wearing Christmas garb.
I couldn't remember.
It was like the day before or the day after Christmas.
Yeah, I think that's right. I kind of do remember that.
I think it was December 23rd, right?
It was like right before or right after. I don't remember.
Yeah.
I'll have to look. But
I
know Tally had like a hat on.
You were wearing a really ugly Christmas
sweater. I had an ugly sweater. And Jimmy, I think, had something red in his pocket. Maybe a red pocket square, something like that.
Well, so at that time, and I've been looking forward to this one because this is another really timely call, Jim Paulsen. And so much of what we talked about went so right. And I'll just, for our viewers, I'll rewind the tape a little bit. In our 2025 outlook that went out in early January, and we had a chance to kind of talk about it in December around that time, Christmas. But we prepared our advisors and their clients for tactical defense, and we laid out 7 headwinds, including a jobs-related growth scare, and all of that happened, a strategic offense or rebound, and we had the 10 tailwinds. Lo and behold, we had the sharp drawdown in stocks followed by a checkmark shaped rebound. Now let's kind of catch up because some technicians, and Jim Warden's a CMT. We have a lot of friends in that realm. They think that we're in a kind of new cyclical bull market now because, and I'm not in this camp, but the S&P fell intraday over 20%. Personally, I think we did get that bear market drop in the NASDAQ and the small caps. But the S&P didn't quite get there on a daily closing basis. But what about you? Do you think this is a young 3-year ongoing bull market move, or do you think that the clock has started over here?
Well, I look at that S&P. I mean, I don't know. It's not much to me. It's kind of a semantical whether it's 20% is magical bold or just a correction. But I would just put it was a darn nice hefty correction, and there's a lot of sense that we need another one right now. It seems to me out on the street that we either need a correction or a bear market or going the way of .com or whatever. There's a lot of that kind of insight. But I think we just had like you said, a 20% drop in the S&P just a few months ago, really. And as you said, it was much worse if you go outside of the S&P. So I think that's pretty hefty overall. And I guess I'm looking at this thing. If I look at, what age is the bull, I sort of characterize it more in terms of its character than its chronological age. And to me, things, I guess, the 2 big things I look at in that regard is kind of where is sentiment, not even just on Wall Street, but just in general on Main Street.
Yeah.
About things in general. And to me, that's still I think it's pretty pessimistic. A lot of weird
Yes.
stuff.
It's really low.
The S&P close to all-time record highs, and I think you got, the CNN fear greed index is like extreme fear right now. The AAII bull less bear is less below average. And then you got things like the University of Michigan consumer sentiment on Main Street,
right.
almost at all-time record lows in post-war history. It's just, so to me, I think it is, those readings, are measures, but to me, you just could see this in the commentary of the day. There's just a lot of uneasiness about things that are going on, and uncertainty, and sort of everyone being somewhat prepared because it's likely to really get rough here. And that's how I feel. So
Yeah,
to me, that's a really good thing. And then I look at capacity in the economy, and one of the really absolutely unique things that the cycle's been doing, and I'm talking about the economic cycle, this has never happened before in post-war history. We are recapacitizing the economy during an ongoing expansion. And what I mean by that, the unemployment rate has gone up from 3.4% in 2023 to 4.3%, almost a full percentage point higher, while we're still in an economic expansion. You can't find any example of that in post-war history. And since they had the unemployment rate out in 1948, where unemployment rate go up at all, let alone that amount, you've had a recession. And so also the factory utilization rate has come down over that same period of time, which is also not unique, but it's very odd. So we freed up capacity in factories, freed up capacity in the jobs market. All the while, we've kept profits fairly decent, real wages pretty decent, but we've kind of destroyed optimism, kind of like we've had a recession. So I would argue that I look at the character of this thing more like a very young bull, where people are still very uncertain about this, like you're early in this recovery, but no one's sure it's going to continue. And there's a lot of capacity that we could use up in the economy before we get into problems like overheated results and things like that. So I've got a thing called the Main Street meter, where you just take the consumer confidence index divided by the unemployment rate. And if you run that back to 1952, it's currently right now lower than about 80% of the time since 1952, which tells me it's younger than about 80% of the other points in time in terms of this stock market run. So I know valuations are high by those metrics, and I know we've had a decent run for 3 years and all that. I still think I think by the time this is over, people are going to feel a lot more enthusiastic, and we're going to be we're talking about having to raise rates, those kind of things, rather than the other way around. I don't know.
Interesting. So Jim, I saw your chart on that, the Main Street meter.
Yeah.
And like it looked like that was when this meter is high, that's usually not as bullish. That's more bearish, right? But when it's low like this, it just tells you there's more room to run. Right. So how do we compare now to like 1999, 2000? Because it seemed like that one was quite a bit higher.
It was. That peak on the Main Street meter, was close to one of the highest levels of the post-war period.
Wow.
And where this one, as I said, is lower than 80% of the time. And I think that, think about, and why is that? You think about the difference between those two. We had absolute full employment at the end of the 90s in terms of the labor market, factory utilization, everything. And we had irrational exuberance on top of that, defined by our Fed chief, right, 4 years earlier. So and it wasn't just on irrational exuberance in the stock market. There was irrational exuberance across the economy.
Yeah.
Everyone was feeling pretty darn good. At that point. So if you think about that ratio, confidence was almost record highs, unemployment was almost record lows, and the combo put it almost at its highest levels of the post-war. Today, you're not exactly the opposite of that, but you're quite a bit the opposite of that. I would suggest.
Jim,
and that's what I'm saying. Character-wise, it's younger than you think.
Yeah.
It's interesting on the sentiment from one of Marty Zweig's favorite measures of sentiment was the old kind of Newsweek and Time magazine covers. And, case in point, we just had some guy put out a book entitled 1929.
1929.
Right. To your point, that makes me feel really, really bullish. And I'm just remembering our last conversation. I guess it was 11 months ago. And we said that things would slow down, but we'd avoid a recession. We were calling it a 2% growth recession, the old growth recession. All of this was spot on. Recession fears would crescendo. That was true. That happened. I put out a chart showing poly market recession odds went up above 60%. Now it's melted back below 10. So it's been the mirror image of the S&P. But we were talking about households and businesses over preparing for a recession that never materialized, too much pessimism, no confidence. And we've got all this cash on the sidelines that could leak into markets. So it sounds like we're kind of in the same place, wouldn't you say?
I think so. I mean, recession fears at the moment, to your point, have calmed down a little bit. But part of that is because we do have more people thinking the Fed's going to have to respond.
They're going to cut.
Yeah. If they tell us they're not, recession fears will spike very quickly again, I think. It's not, it is, I love your, the old days, like say you look at the Economist, the front of Barron's or the front of Business Week, or, like you said, in recent times, we had Ross Sorkin bring out the 1929 book, and he went on 60 Minutes and told us that's kind of where we're headed now. And you have Jamie Dimon telling us we have cockroaches in the credit system. And you've got Bill Gross saying that 4% 10-year seems absurd when you got government debt where it's at. It should be closer to 4.5 to 5. And it's got to be every day of the week somebody's talking about how this is dot-com redux. I mean, it's every day. So I think that was not the case in 1999. 2000.
Yeah, that's true. And everyone was bullish. But I remember because I worked for Wells Fargo at the time, and you were the chief investment strategist, and you were one of the few people that were saying, "Oh, this is overheated. This is too much."
I'll tell you, I went to the San Francisco Giants ballpark, opened up, I believe in the late 90s, right in 99, I believe.
Yeah.
The dot-com.
I wasn't at the first game, but I was one of the first games. And I'm a big baseball fan, but when I got to that stadium, the thing that hit me the most, if anything, was all these .com banners all over the stadium.
Oh yeah,
all these names, some of you never heard of, and that really stayed with me. I thought, boy, this is like your shoe shine guy, telling you how much he's buying in the stock market or something.
Yeah.
But today it's the opposite, right? It's the fear mongering, right? So this is kind of the breakout scenario that I think we're correctly preparing for.
So Jim, why do you think that the consumer sentiment is that low? Because I compare it. I mean, this is as bad as during the pandemic. It's as bad as like during the financial crisis. Is it all political, or is it like just too many people doom scrolling, or?
I like that. It's probably a product of a lot of the things you think it is, but here's my take on it, why I think most of it. And if you looked at confidence, it got collapsed during the pandemic, no doubt about it. Then it did recover during the 2020, 2021 bull. It went up, not all the way back up, but it went up at least maybe 60% of the way back into normal sort of recovery areas for a little while. And then we went into 2022. And in 2022, we had a bear market, and the Fed had started tightening on inflation. Inflation rolled over, the Fed was tightening. It had been tightening for a while. Bond yields had been going up for a while. The dollar had been going up. In other words, there was tightening going on. And the economy started to slow, and we went into a bear market. And what's interesting to me when I look at that period 2022 onward is I look through the economy in several different ways. And if I look at new era pursuits, so if I look at the SP 500, or I look at the SP 500 communications information versus the rest, or I look at the S&P versus the Russell 2, small company, large, not for their stock performance, but for their fundamental performances. So let's just take Russell 2000 companies and S&P 500. I go back to 95. both their employment trends, their sales trends, their earnings trends all went up and down together with recoveries and expansions. You got into 2022, they both, the Russell 2000 fundamentals all went south. S&Ps just went sideways for about 3 months, and then they took off again. But Russell 2000 just kept going down, never came back until just a couple months ago. It's now bounced up a little bit. If I look at the S&P and divide it between the S&P communications and technology and the rest of it, same story. X-Tech, X-New Era, and the rest of the S&P, they move up and down together until you got 22. The rest of the S&P went down, never really came back. S&P X-New Era earnings are not yet back to their 221 peak. The employment level there is still down. In other words, what I think happened was that there was a great divide between New Era and the rest of the economy that occurred in 2022. And then it got worse because the Fed was, number one, focused on inflation. And number two, every day they'd look at the headliner S&P companies and say, they're doing great. Oh, yeah, they're all going up. Stock market's up. Companies are great. So they just kept tightening. But the reality was most of the economy was in recession, and it just kept getting worse. Mm-hmm. So the vast majority of people on Main Street don't work for S&P 500 companies. The vast majority work for small companies, medium-sized companies, and they were all the whole time have been screaming, it's not good. It's not good out here. That's what they've been telling us, right? And market S&P keeps doing well. The headliners keep doing well, but they're saying it's not good out here. And I think they've been correctly saying it's not good out here because not only did we have recession in most of the economy, but they didn't get the normal policy response. If everyone goes in, they would have been easing again, but they didn't. And so I think what happened was why this occur. I think the S&P New Era part of this economy has done two things. It's gotten big enough for the first time. By some measure, I say it's accounting for now more than 20% of the GDP change. Okay, up from not that long ago, for example, accounted for maybe 8% in the 1980s or even less.
Yeah,
it's gotten big, but also I think that whole part of the economy is not really responsive to the normal cyclical forces that drive everything else. If I'm Apple and I come up with an iPhone, I don't care if interest rates are 30% or zero. It makes no difference to what's going to happen to my business because everyone in the world needs what I just invented. And I'm going to have solid growth regardless of whether everybody else is dying. Okay. And so I think they did two things. They got big and they got invariant to the normal cyclical forces, whereas everyone else is still very dependent on it. So we just went through our first recession where tech didn't recess, right? But because of its size and its headliners, it kind of overwhelmed the data in the rest of the economy enough to make it look like it was just a slowdown. Also, we were coming from, you got to remember, after the pandemic, we were growing over 10% in real GDP terms at the peak. And then even when we slowed, it slowed to 8, and to 5, and to 4. It was still pretty good. And then when we finally started to take note was when it slowed to 2, which is just this last year. And now we're kind of, what's going on? So if I look at the difference between total profits in the United States for the NIPA profits, and you look at the bull market start from October 22 to date, the information sector profits are up 88%, almost 90%. All the rest are up 10 over this bull market in total. And that's just saying S&P profits are about 18 to 20% above their trend line since 1945 or 47. NIPA profits, total U.S. profits, are still 5 to 10% below trend line.
Yeah.
And if I go back historically, those two aggregates move together above and below trend line throughout time until
2022.
And
Can
so
I
I
chime
think,
in on that real quick?
yeah,
So,
go ahead.
the government shutdown has been a blessing in disguise in a few different ways, but it forced me to develop a new kind of S&P 500 productivity gauge. And it's really simple. I just looked at aggregate dollar sales in level terms, and I divided it by private payrolls. So, how much sales each employee in the S&P is generating. If you take a rate of change on that, it's over 5%. So to your point, the typical S&P worker is about 3 times more productive than the overall worker in the U.S. economy, and it beautifully solves the mystery of the productivity miracle and this huge margin tailwind that's driving earnings for the big companies here.
I agree with that, Tally. That's had a lot to do with it. I've looked similar measures at what I call real profit per job. I call it profit productivity. And you go back to 1948, and it stayed in the real same range from 1948 to the early 90s, just sideways. Since the early 90s, to your point, it's gone up 3.5 times. And to profit per job in real terms. Yeah. And I think that explains why valuations are up as well. But that's a whole different story. But I do think that tech, in general, tech has finally gotten big enough. It's on its own cycle. And it's not the normal industrial cycle. It's on the innovation cycle, which, by the way, I don't think any one of us knows enough about. That cycle will crash eventually. It will go through its own cycle. And no one is really thinking about what drives that and what happens when it goes down. And I don't think it's going to be because of interest rates or lack of liquidity. I think it's
credit.
Credit. It's a completely different cycle. I think it exists.
Yeah.
But we just don't know what it is. And I've been looking at that for about a year now. I haven't found a lot of good stuff that helps me even correlate with it, to tell you the honest to gosh truth. So, but I do think there's something there. And right now, here's where what's happening though is growth has gotten slow enough now. I think when we get all this data, we might find out job growth's flat, zero growth, and real GDP might still be above 1. I don't know, but it's pretty slow. So what you're starting to see now is, since the Fed has started to show signs of easing, other things are picking up. Since the dollar's come down for the first time this year, international stocks are doing better. Mm-hmm. Since you start to drive liquidity up a little bit and you drop rates a little bit, a little bit, micro caps, smalls have shown a little more life. Okay. If we finally do get out of an inverted yield curve and steepen the curve, you're going to see cyclicals, I think, do a little better. So a lot of this stuff that hasn't performed largely, I think, is because we've been tightening this entire bull market, and that just doesn't normally happen. And so we might, rather than crash tech, maybe tech will just underperform, and all the stuff that needs policy juice and finally gets it outperforms for a while.
Interesting.
So a catch up, basically, rotation.
Right. But it doesn't necessarily have to be a crash in the tech. It could just be they don't do as well.
Right. I'll send you the piece, Jim, but I actually took a shot at it. I laid out 5 things to watch, and they're, again, admittedly, they're conceptual, but,
for the innovation cycle?
Well, the AI as a theme that could extend the cycle and ultimately end it. Just trying to get our arms around this. Well, one of them, which is obvious, we talked about this with a PM at Barron Capital, but we could hit our power generation limits. That could shut the whole thing down, which is an interesting angle. That's practical, right? It's measurable too. But other ones would include, what about investors just kind of throwing in the towel and getting fed up with the negative returns on invested capital, ROIC. Another one would be, boards deciding, we're spending 60% of our operating cash flow. We'll run it to 100, and then we got to start, repaying that money or whatever to investors in the form of dividends and buybacks. So you can watch that too, but that's, the party's over when those things start to happen, I think.
Yeah, we haven't seen some of that. One thing, I'm not an expert on the AI, but they are starting to become, for the first time, more capital spending companies, as opposed to, it kind of reminds me of the old, when we broke up the Bell operating companies back in the 80s, and all those companies went out and they laid fiber optic cable down the rail beds.
Mm-hmm.
And of course, we only needed one of them eventually. So most of them kind of bellied up, but they got into trouble when they left their, sort of steady Eddie utility character, became capital investment heavy companies, and then over capital investment. And I would say that's kind of what AI is starting to do a little bit. But I'm with you, Tally. I don't think we're there yet. I think there'd have to be quite a bit more of that to happen before we saw that.
I have a quick question on just kind of what your comment around this potentially being an early stage of the current bull market. I think many of us agree that in order for this current bull market to persist, there has to be some broadening out. And to your point, we've started to see a bit of that. I struggle with trying to understand the catalyst for, the mid, small, micro space. I mean, the number one rationale that a lot of people give is further rate cuts will be supportive, but that's a fine line too, because 2, maybe 3 rate cuts, we can still, keep ourselves out of a recession. 4 or 5 means we're probably going to be in a full-blown recession, in which case the smaller cap parts of the market wouldn't do well. So is the catalyst really just like the trickle down of AI and increasing productivity in these smaller companies? Or like, how do we kind of balance or teeter on that line of more policy support should help small caps, but also too much policy support means we're headed for a recession?
Right. I think you're right, Paisley, that if it's a full on, we're trying to, get out of a recession, that's not going to be good for anything or anybody. Yeah. But if it's driven by forces like we've been holding policy way too tight too long, and we're going back to normalization, then that could be interesting. And that's where I think we got a shot at, because I just give you some examples of this. We've had a yield curve that's been inverted for the longest period of time ever in history. We have the annual M2 money supply growth rate came out in 1960. And if I go back and look at all those months, it was never below 0 year on year until this bull market, when it was negative year on year for 16 consecutive months. And even now, real money supply, taking out the inflation rate, is what, 1% growing? That liquidity situation is so far below norm at the moment that there's room to lift that for a period, not so much because the economy is dying, but just to get back to some sense of normality. I would argue that's somewhat true, certainly in the yield curve. I would argue it's true in the real Fed funds rate. If you look at the average real funds rate, just going back over the last 20, 25 years, which I think is important because the U.S. economy had a definitive downshift in sustainable growth starting in about 2005, 6, that it's never really recovered from. It's kind of went down and stayed at very, more like the 2% area than the 3.5% area since, for a whole host of reasons. But during that period of time, we've kept the real funds rate negative most of the time over this period. Now, during much of the financial crisis of 08, 09, that wasn't low enough even to barely keep us at 2% growth, right? I don't think that much has changed today. The only thing that's changed is the Fed has this fixation about a 2% inflation rate, which is, to me, absurd. I don't know, where that 2% came from, but it came very arbitrarily from some finance minister in New Zealand in the early 80s that was on a television show and made an offhand comment about it'd be nice to have like 1% inflation. And eventually they rounded that up to 2. And they adopted it as a policy, and then other central banks started adopting it, and then Ben Bernanke adopted it in 2012. But there's no academic research behind it. It's just arbitrary, but we treat it as though it's the gospel. And my point is, what if that just goes away? What if we decide that growth is now more our mission than inflation?
Yeah.
Then I think there's a lot of room to move the money supply up, to move interest rates down, to move the yield curve steeper, to bring the dollar down, and most importantly, to raise confidence in this country. One of the reasons people feel so bad is because they're not doing well, and everyone is fighting to slow the economy even further. if the Federal Reserve comes out and says, we are finally going to try to create more job opportunities rather than bring inflation to its knees, I think that would maybe help confidence.
Sure.
So I think there is some room. If you go back, the Fed eased for a little bit late last year, by the end of the year, and then it stopped, and then it started easing again a little bit. Look at what microcaps have done during those two periods of time. Very sensitive to that. Even smalls were sensitive to it. I've got if I look at the equal weighted S&P index and just go back, I can't remember how far this chart goes back, but I think it goes back to like 1990 at least. And if I look at that year-on-year growth rate in relative equal weighted S&P to the overall S&P, and I lay on top of that something I've used for a lot of years I call total policy stimulus. And this is not in your Econ 101 textbooks by any stretch. It's not approved by anyone, but I'm just taking separate policies. I'm looking at annual growth at M2. I'm looking at the Fed funds rate, the fiscal juice as a percent of GDP, and the 10-year Treasury yield, and I'm taking their percentile rankings historically. So, and then I can add them up, right? Take an average, and if I take that average total policy stimulus and I lay it across that annual, they look very similar, and both have been below zero during this bull the whole time. So if we would move that policy stimulus to above zero, I think equal weighted would outperform it. If it does, there's a high correlation to smalls and mids. Some of these other
yeah.
I wonder too.
Can I chime in on smalls for a second before we leave that subject? Because I just put out a big special report on the subject, and it's ironic, but economic recession is actually one of the cyclical catalysts out of which small caps always surge. And I think that's known, but I think it was the absence of a recession this time around that people were really kind of waving as a question to me. But I agree on that score with what you said earlier, Jim, that technology is kind of on its own cycle. And if you look, I put out 5 catalysts. It's not just one, but it's like earnings recovery for smalls could be very powerful next year. Yes, rates softening a bit, but the risk premia have been coming down. Volatility has been easing, calming, keep calm, carry on. And the technicals, and that's the chart I want to kind of bring out here. When you look at the Russell 2000 total return relative to the 1000 total return, we're bottoming at about the same level. And I know the bottom of the chart is not support, but it's very similar to the point where we had a stealth small cap rally, and that was late 1997, 98, around that point. So I think it's underappreciated, and it's not so much of a cyclical catalyst as it is a secular one here. Think of it like a hedge against tech mania risk, if you will.
Yeah, I think that the last time smalls outperformed was in the 2020, 2021 bull market. Mm-hmm. And think about how much stimulus we brought to the party there.
Yep.
That was a get out of the COVID panic.
Yeah.
It was 25% money growth. And
yep.
I mean, it was some of the greatest stimulus ever employed at this time in the United States. And smalls beat them. And I do think, the other thing is, one of the reasons tech has done so well is because their fundamentals are just almost unprecedented. That's true. But I think a big chunk of their outperformance is because they did this at a time when everything else was doing horrible. And so the relative chasm of their performance was worth even more at that point than it would be in normal times where we had a full-blown recovery with everything doing well. The 90s bull, between when it really took off, let's say 94 to 98, before the last 2 years when tech just went irrational. But during that first several years, all the rest of the S&P kept up largely with tech. It also was in a bull. That has not been the case here. Mm-hmm. This has been you're either tech or there is nothing else. And I think some of their high values and their extraordinary performance is just their scarcity and rarity character, in addition to their just incredible fundamentals.
Yeah.
And that's what could go away if we stimulate the rest of the market a little bit.
Yeah, that's what makes me nervous right now. And I agree from like the fundamentals, a lot of the technology companies deserve these valuations that they're seeing right now. So it's not so much the level, it's the concentration of where we're all kind of betting on will continue. And I think that's where the biggest risk lies for markets over the next few months is the embedded expectation. And by the time this episode's released, we'll know a little bit more of NVIDIA's earnings this week. But again, we kind of all sit back and wait. I think right now they're saying NVIDIA volatility, the implied vol on earnings day is plus or minus 7.5%. And so as we know, that can meaningfully impact every single investor's portfolio, the markets at large. And so like having to wait with bated breath every time one of these, 3 or 4 companies releases earnings or a new technology or misses, that's where the risk and the concern I feel like lies from a market perspective. And so then it just becomes like, how can we have the broader participation so we don't all have to worry and lose sleep every week?
I kind of agree with you. That is if it was to come apart quickly, then you got a problem because that's so big and all the funds out of there are so outsized, right? Everyone's given up on smalls and mid caps. And we've sort of cheated in the direction of, right? So we're probably all overweighted that area. But I would say this a little bit. I agree with you. I mean, it depends on the speed by which that all unfolds. Maybe it's good that crypto's falling apart right now a little bit. We're starting to burn parts of this out. But I would say what another big thing that's different that kind of gives us a little buffer is that I wrote a piece about this recently about this has been a fear-based bull. And what I mean by that, it's been led by a lot of the traditional fear-based assets. So as good as the S&P 500 has done since October 22 to date, gold has doubled its performance during a stock market bull, which is unheard of. In the 1970s, gold did spectacularly, but only when the S&P was in a bear.
Yep.
When it was in a bull, it didn't do well. This time, it's done good during the bull. So has cash mutual funds. They've gone up to almost, 8 trillion or getting close during this bull run. Okay. So has the dollar, safe haven global dollar until this year went up. And even bonds have had positive returns during this period of time.
Yeah.
So I think it's sort of encouraging a little bit that while people have a lot of this high octane tech, they also have a lot of these traditional, what you'd only own after a 2-year bear market kind of asset, which is sort of a buffer against a rapid pullout. I don't think any of those were around, like, for example, at the end of the 1990s.
There's an angle here. I think we were talking around it a little bit about quality, especially in the equity market. And this might be underappreciated too, but the Russell 2000 rallied over 40% total return basis off the April low. And what I noticed, this is interesting, is the pretty sharp difference or spread in the return between the Russell 2 and the S&P 600, which is higher quality. So it's actually the junkier, lower quality stocks. That makes me a little bit nervous, to use Paisley's term. I might actually do some switching into the 600 after this call.
Well, I would say, I hear what you're saying, Tally, but there has been a lot of that. Unprofitable tech has picked up. Okay.
Yep.
Unprofitable smalls. And normally you'd say, and a lot of people have made this point, that it's a lot like the end of the 90s, where it really started to show up. These animal spirits started to get really out of control. I would say, though, it also correlates with the beginning of Fed easing for the first time in this cycle. And it also, back to Jim's point earlier, you could look at this as a slowdown in the economy of the Fed is responding, or ultimately, as I point out, maybe the Fed is responding to a recession in the old era part of the economy. If that's the case, then you'd expect all the junk to start leading the next parade out of this.
Sure.
And it's hard to know which one that is, but I'm not so sure this time around it's necessarily just froth.
So policy is pro-cyclical, and now we're kind of playing with the notion of bailout checks funded by the tariff money. Trump has been tweeting. Can you imagine if that were to happen? We're going to have a boom.
My kids are, I guess they're all in their 30s now, but they all keep getting these checks. First it was COVID, right?
That's right.
COVID checks. And now they might get tariff checks. I'm thinking, this is ridiculous, man. I want to be a 3-year-old.
But it's a bit now of like, we talk a lot about the K-shaped economy, and now we're talking about K-shaped markets. And so you can start to see like how this becomes really difficult as an investor or even as a layman to digest and understand like what is happening, what's going on.
You know, I hear that K-shape, and that
if I hear it one more time,
K-shaped.
It's okay. It's wealthy versus rest.
Yeah,
but I don't think it's, and there's some truth in that. But I think it's a different division, as I pointed out. I think it's new era versus old.
Yeah,
and it's a lot of the old economy that just is not doing well, and they're making the wrong distinction necessarily. I think there's a lot of small cap old companies, owners, wealthy, that aren't necessarily doing that great in their business.
Mm-hmm.
And so it's different than a K-shaped wealth differential.
Mm-hmm.
It's more about a old versus new era economy differential. Also, the Gini ratio really has been flat now for the last couple of decades. It hasn't shown a continued rise in inequality, so to speak.
You know, I actually have seen an improvement in earnings breadth across some other sectors. We are seeing participation from sectors like communication services, healthcare, industrials, financials, and even materials. I know the stocks haven't responded as much as we were hoping, but the earnings have actually been improving.
I haven't watched that close enough, I guess. That's interesting.
Yeah.
Another thing that's kind of interesting along those lines, Tally, is like the breadth related as per usual to the AI theme, but the impact that this has and will continue to have on data center build out. From a hard materials perspective, I think there's a lot of discussion around this trickling down and leading to more kind of increase in prices for commodities broadly, assets like infrastructure. And so again, like provided, the domino effect doesn't start to topple over, you can see, 2, 3, 5 years out, the positive impact that could help kind of pull this into a longer bull market. And I agree with your comments, Jim, and this being at least right now, the signs of this being an early bull market. So we just kind of need those AI companies to continue to deliver. Even if it is more of like a status quo, they don't need to keep, hitting the ball out of the park every time.
Well, I've got this other chart showing to your point that the growth gap between the Mag 7 and the 493 is normalizing. And so I kind of agree with your comment, JP. Why does there have to be a crash in tech? Why can't just the rest of the market kind of catch up? My catchphrase has been, I think technology itself should enable a broader market. Just by virtue of how the users are going to benefit. All the old economy stocks, like utilities, could be radically transformed and change these business models.
They're being transformed. I mean, right now. So Jim, I was going to ask you about what the Fed is looking at, and like I don't know why. I love technology. We've done very, very well, by the way, with our portfolio positions, and but I'm a little concerned with employment. And I read these reports. I read a report. B of A is now investing a lot more in AI, and they're saying that one banker can service 50 clients instead of 15. And so reading things like this makes me a little bit, I feel like it's still slow moving, but it makes me feel a little bit concerned with just more of a deflationary impact and labor softening. I just want to get your take on that, what you think the Fed is looking at, and how long does this take before, the smaller companies are using it? And I don't know.
I'll get back to the Fed in just a minute, but the AI thing, I'm no expert on it. I don't know how to quite look at it. I can get myself, I've run the full spectrum of, every innovation cycle, even going back before U.S. history, okay, has been a job creator, wealth generator, broad-based for the masses benefit.
Yeah.
So that, for me, that is strong evidence that the odds are in your favor that AI is not going to be any different. Now, but you do get kind of nervous about it. I have seen a little bit of data on AI trends and new business formations that are very favorable. So it does seem to be some positive correlation leading to greater business, new business formations.
Yeah, it's creating new jobs for sure, and
right.
a lot of businesses are taking advantage of it.
Yeah, I don't know if we get into the speed of these things every time. When you first had a PC, or it created job losses and then job gains, but it's almost like the speed is so fast with this thing now.
Yeah.
The job loss dent could come way before the job gain. I don't know. And then don't even get me when you go into robotics coupled with AI. And I've read these guys that say, well, the current AI is going to create a new AI. And then a new AI will create a new AI, which will create a new AI. And pretty soon, they'll be, when they get into not just being able to accumulate existing information, but create, I don't know where that goes. It's a little spooky, and all the ideas of robotics replacing humanity. But I think you ought not go down that path too far, because.
But do you think the Fed looking at this to say that this is a deflationary pressure and they should be easing, or are they just not looking at it?
Yeah, I'm really critical of the Fed, and I probably overly so. I just feel like, the Fed did not start raising the funds rate until May of 2022 or April, within about, and then inflation peaked in June of 2022. They didn't cause inflation to peak. They were way too late for that. But then amazingly, they've been tightening ever since inflation went from 9.1 down to 2.5 and stayed down around 2.5 to 3%. And there's never another precedent. If you go back to World War II history, at least, every major inflation surge that we had, including the 70s, the Fed would tighten when inflation rate went up, and it would ease when inflation rate came down. Except for this one. Right. It stayed easing while it went up, and it's been tightening all the way down. Never before have we had that happen. Now, fortunately, not everything's in their control. So while they didn't tighten, bond yields tightened, the dollar tightened, the money supply tightened, things that are out of their control. Fiscal tightened, a lot of things tightened, and that's what brought it down. But I don't understand. If you look at a chart of CPI inflation of 3%, and you go back historically, it's actually below average right now from where we typically have been, going back over history, or just going back even since inflation broke in the 70s. It's below average. PPI inflation at 1.9 going back nothing looks abnormal. Nothing looks scary. I don't see any evidence that this is 1970s over again at all. To me, I think they should have been easing a while ago, and I don't really understand. Also, you've got these other things going on that we didn't have before, like people are still reducing debt burdens in the household and the corporate sector. They're raising cash. Defensive holdings throughout. These are all deflationary sort of in the sand that they just seem to continue to ignore. And I don't know if it's going to take negative job creation or what. The good news in my book is I think it's hard to create a recession today because no one's overextended in debt. Everyone's overcashed. Everyone's got a lot of equity on the balance sheet. Everyone is fully expecting a recession because Jamie Dimon's been telling that every week for 3 years, and they're fully prepared for it. How do you have a recession when everyone's sitting around fully prepared and waiting for it? It's hard. It's hard to get one.
Yeah, I was going to say, like, that combined with the fact that we have the Fed sitting and waiting to cut rates to protect us if we do enter it, right? So even I 100% agree. Yeah.
So another way to say this is don't fight the Fed hasn't worked since the pandemic. The tail has been completely wagging the dog for the past 3 years.
Right. I get so critical because I sometimes get irritated just with the bi-monthly meetings of the Fed. And if you look at like a day before and a day after and the day of the Fed meetings, VIX goes way up and then it goes way down all the rest of the time. And then returns go down and then they go all up all the rest of the time. So the only thing I think that the Fed meetings do is they trade a trader heaven. You just trade VIX for 3 days and then you just go back to what you did before. I don't think they really give us any information that we didn't know before the press release. I mean, we pretty much have it all.
Yeah.
I don't know. I'm just.
I also think too, like they don't want to upset the apple cart in the sense that if the markets are pricing something in, they would be hard pressed to deviate from that because they know it would just push a bunch of volatility into the marketplace, which would backfire. So I'm not saying that they're, not to get into like the political independence topic at all, but just saying markets, if they're pricing in, X amount of rate cuts, it's going to be hard pressed for the Fed to take another side on that. So it is a bit of like the tail wagging the dog. And we kind of, like you said, is like, we already kind of know what's going to happen before we even get there. Why even have this big hurrah around the meeting and the presser?
When I was educated in the late 70s and the early 80s, the theory around the Fed at that time, this was in economics, but the whole theory at that time, before I got out of school, was that the Fed had to be absolutely mum. And the reason they'd only release a short paragraph 6 months after they had a meeting was, and none of them spoke, because the whole idea was the only way monetary policy could be effective, this was the theory of the day, was if it was unexpected policy. If it was full expected, they couldn't have any impact. They'd lose control. And we've gone from that mindset as a society to now we got 12 of them running around talking every day out of both sides of the mouth. And we got a media, presser going on every month and wait with bated breath. It's just so foreign to me, the difference. And I agree with you, Pace. I just don't know if there's much value added from what, like you say, we already knew before it all started anyway.
It is interesting though, Jim, to your point, in the daily and weekly rhetoric from, the different Fed chairs. And we've started to see a little bit of this polarization as well. I think that's another kind of shift, is that for the most part, for the last, 5 or 10 years, most of, the Fed members are all kind of on the same side. There might be 1 or 2 dissents here or there, but in just the last few weeks, we've seen quite a bit of dissent come out. Mm-hmm. So then I fear too that the market starts to look at that. It's like, you know what, let the kids fight in the corner. Like, we're just going to do our own thing. Does it even really matter? So.
I think it's starting to reflect the country in general and our political system. And here's what's going to happen. The Federal Reserve will come out for the press conference one day and he'll say, we're going to pass this on to the Supreme Court to decide for us. We can't decide. We're gridlocked, but we're going to pass it on. Let the Supreme Court settle it.
Yeah, I mean, you have Stephen Mirren saying Stephen Mirren's calling for 100 basis points of cuts, and then half the voting members are saying we shouldn't be cutting at all. And it's like, I mean, when you have that much polarization, it's hard to instill that credibility. So they'll need to figure that out.
Ultimately, though, if the economy weakens enough, right? They won't have a choice.
Yep.
And I think that's probably going to be the way that's going to go. And to your point, I hope it doesn't take a recession to get there, because that's
one of the tracking models for GDP I saw. I guess you can question the data because of the shutdown, but it's close to 4%, seasonally adjusted.
It's been frozen there though since they shut down the government.
Yeah.
So data releases started going away. I think it's a big risk, what's going to happen with that now in the next 30 days. I mean, the data dump we get, it's hard to know.
But the thing is, we've had plenty of earnings. We've had plenty of earnings information, double digits. And if there's one thing that we know historically, you've never had a recession in the economy and not have a recession in earnings. Those things coexist. You can have recession in corporate profits, but not an economy-wide recession. But that's not what we're dealing with right now.
Yeah.
So I think that this recession fear is overblown once again.
Yeah, I'm a little worried. I mean, like if I take the Citi Economic U.S. Surprise Index, and you lay the relative performance of cyclical sectors of the S&P 500, those things pretty closely correlate. And since the shutdown, cyclical stocks have just died.
That's why I think they're interesting here. They're
it's
on
pointing
sale.
to much slower reports that are going to come out, but I don't know. I guess we'll. I just think it's an interesting. I mean, if I was a trader, I'd probably be loving this because there's going to be an opportunity with this data dump to take a position one way or the other. You know?
So I'll stick my neck out because the setup right now, and Jim and I have been talking about this since the summer, it's very similar to what we saw in the first quarter. We've had this kind of stealth defense rotation. Healthcare has been doing relatively well here. And the cyclicals I think they're on sale now. And if we're right about the direction of this market, I think now we want to shop those sales and the cyclicals. That's my humble opinion.
I'm with you on that.
Don't overstay your welcome in the defensives, guys.
So, Jim, I wanted to ask you about just kind of like when we look at the net worth as a percentage of disposable income, we're doing really, really well. When you look at just like how financially well off in aggregate we are, it's great. It's fantastic. And we know with the, demographics and, baby boomers, and a lot of them are sitting on that cash. But then there's this big gap, right, with the people that don't own homes. Maybe they don't have a 401k, and inflation has hurt them probably more than anyone else. What do we do? I mean, is there something that we can do to get? I mean, I know the people in New York City voted for a new mayor, and it's like they think that's going to solve it, but like that. I mean, that hasn't really worked anywhere long term. What do you think is the solution for?
Well, this? I've done a little bit on around that question a little bit over the years, and I mean, one thing to note is there's always going to be the poor among us. And and it's true, they always suffer more than the rest of the society. There's no doubt about that, and that's kind of always the case. But I do think it's gotten worse, and to me, I think it comes back to this idea of this growth downshift that the United States has suffered. I mean, it literally from 1948 up till about the early 2000s, real GDP would grow at 3.5% on average.
Yeah.
And it now grows at 2% on average since. That's a huge decline in average secular growth. And I think that the slower the overall growth rate of the economy, the more difficult are the poorer boats in the harbor. More the difficult it falls. You want to get the least among you doing well, then you need to get the whole thing doing well. And I think that's what we've missed in the last 12 years. And particularly it's gotten worse since COVID, when we've been fighting inflation. To crank down everything else. And I personally think we put much of the rest of the economy into recession for the last several years and left it there. And so I think we ought to have a number one mission to crank growth up and quit worrying about inflation, because I don't think it's going to be a problem.
Yeah.
We've got disinflation in our blood here. We've got being led by a sector that exudes deflation every day it operates.
Sure.
Back in the 60s and 70s, we had automobiles, and their tagline was sticker prices go up every year, and everyone else followed suit. Now we've got tech, sticker prices go down every year.
All the time. Yeah.
We've got people, as I said, contracting balance sheets. When I was a kid, the adage was, it took money to make money. Go borrow money, young man. That's how you're going to make money. That's dead, man. Now it's, watch your balance sheet and contracting. That is a disinflationary force going on. We had 2% plus labor force growth back in the 70s. We can't even maintain one. We've got old guys like me still hanging around. Rather when I grew up, it was the young, the big meat of the distribution of this country was a bunch of young bucks. They're aggressive, and now we just got old guys and gals around, and we got no one behind us. I come from one of 7 kids. I've only made 3 labor inputs myself, and my kids are making fewer than that. And that's kind of the story of America. And it's so, how do you get inflation when our population is going to flatline? And so I think we got to quit worrying about this phantom inflation. The only inflation we've had since the 1970s was one time in 2020 to 2022, and the only way we got it was we officially shut down the entire world for a period of time. Said no one can leave their homes. And guess what? We ran out of stuff and inflation went through the roof. Okay, for a short period of time. But outside of that, we really, I don't think, really had inflation or have one, but we do have a growth problem that's getting down to the lower half of the distribution. And that's on us because we're contracting growth. That's my 2 cents on that.
Well, and a 50-year mortgage probably isn't going to solve a lot. I mean, like, it just seems kind of odd. Like if you're that young and you're going to have a mortgage that goes out 50 years, I get the math, but like just thinking about it, 50 years is a long time to pay off a home.
Yeah. You can start to see also, just to your point, Jim, from the deflationary forces. I think the bigger picture, a lot of times people are talking about inflationary forces from kind of the deglobalization and onshoring and the increase in cost of things. But to your point, from a population perspective, I mean, birth rates are obviously been declining and have been for decades. So if the population is shrinking and much of the population cannot afford to buy a home, it's hard pressed to see like how you're going to have more money circulating. I think people are kind of choosing different lifestyles. And that's where I always wonder if like we're in this, it's been ongoing for a while now, but this regime shift, and it's hard to see how we have those inflationary forces with that underpinning.
Right. And don't get me started on these tariffs, right? I mean, tariffs are a tax. When you tax something more, you have less of them, whether it's corporate profits or income. So you got to go easy on the tariffs. I think the administration knows that, and they're kind of walking it back. And
I guess.
What were you going to say?
My whole thing, I agree with you, Tally. They're absolutely a tax. I mean, as I said, we have this great growth downshift in the economy over the last 20 years. And what have we done of late? We've taken the money supply negative. We kept the yield curve inverted. We kept the real funds rate extraordinarily high. We've raised the dollar by 50% from its lows almost to a record high at the start of this year, its highest level ever. Fiscal juice, it's raising taxes on the global economy through tariffs. I mean, it seems kind of obscene to me. If the whole idea of tariffs is Trump has this vision of making America competitive in world things again, there's a much better way we could have done that. Let's just drop the value of the dollar. If you drop the dollar 10%, everything in America becomes 10% cheaper.
Plaza Accord style.
Yeah, and so that we could do that, and I just think I think we're suffering a little bit from our obsession with over tightening, if you will. But the flip side of that is we could reverse that stuff, and we got a lot of room to ease, which is bull market, baby, if it's done. And I think that's the good news of it. Not only that is that we haven't the missing ingredient in this bull market. Maybe we'll never get it. And I would argue the missing ingredient on Main Street in a lot of ways has been animal spirits. We've never allowed them to percolate. That's because we've been constantly cranking them down. And I think the complaints on Main Street sort of are reflected by the lack of anyone really aggressively going after those animal spirits. If we could create those, I think we'd feel better on Main and Wall at the same time.
It reminds me of that famous quote from Captain Bligh in the book Mutiny on the Bounty. The beatings will continue until morale improves.
Yeah, it's like that, something like that. Yeah.
Well, this has been great, guys. We're over by 9 minutes. Any more questions?
Well, we're actually only over by 3 minutes, Tally, because we had some technical difficulties there in the beginning. So I only have one other question for you, Jim. What are you most excited about over the next 5-10 years? What excites you the most?
Well, I'd probably say it's my grandkids, my 3 grandkids.
Of course.
A lot of fun with them. But I'm kind of beyond a lot of the professional goals that we were trying to build when I had a harder fight. I'm just having fun these days mostly. But I guess I think it's hard not to be excited by the pace of change with technology, even for people like me, where a lot of it's probably beyond me too. But I think it's hard not to be excited about that and where that could go and what that'll mean. And I think that it's not crazy, but I really think it's really made the world smaller than it ever used to be. And it's made
100%.
I think it's harder to go to war than it used to be because we know all these people better than we used to know. We've been in those places where there's wars, a lot of us, or we've met a lot of people that are involved in those wars. A lot of people live among us in this country.
Yeah.
And we just think that that's something that even as a kid wasn't there. We would watch the Olympics every 4 years just to see a Russian. Literally, that's what made it so unbelievable. Wow, they look like us.
Yeah.
It was, and I just think there's something inherently good about that.
Yeah.
Bringing the world together, even just in my time in this country, growing up in the Middle West and being in Wall Street's business, because of technology, literally, I probably got to know a lot more people like yourselves than I ever would have met in the 30 years prior to that, being in the same business in the Midwest. And I think that sense of the good side of technology, I think, is it truly does break down sort of distance barriers, and maybe it's going to overcome even some political barriers.
Yeah.
Think about crypto. If it really matures into a currency for the world, then we don't need political currencies, political boundary currencies. That's a boon for economic growth.
Yeah.
Also a boon to some extent for mankind.
Yeah.
As opposed to being in silos. So I don't know. Maybe that's just all pie in the sky. But
no, I love that. I think we need some positivity. So that's great.
Oh, absolutely.
We'll see.
Well, Jim, it's been an absolute pleasure to have you on back with us. Thank you so much for joining us. Tally, Paisley, thanks for joining as well.
Yeah. One other thing, Jim, I want to mention. Jim puts out a wonderful Substack. So
that's right.
All of these thoughts he's just kind of shared at the surface today. If you guys want to get into kind of more of the charts that he spoke to, make sure to go subscribe to his Substack. So
and that's Paulsen Perspectives.substack.com, right?
Right, that's right.
Perfect.
Me and the other 20,000 authors.
Yep.
I love it.
Come and dance on our floor. Take a step that is new.